So if you know what this is, you're probably already cringing at the sight of the Form 8621. So this is for PFICs, or passive foreign investment company. To me, this is probably the most vile and disgusting form that the IRS has ever put together. It's complicated and cumbersome from the tax preparer's perspective. It's unfair in a lot of cases to the taxpayer's perspective. And to be honest, I'm not sure the IRS really knows what's going on with this form either. So just all around, it's confusing, and that kind of translates to the K-3, because the information you're getting on the K-3 is sporadic in the way that it's provided. So what I want to go over here is some of the examples that I've seen. I want to go over kind of some of the basics. I'm going to spend a little bit more time on this one than I did on the others, to go over some of the basic rules with the PFICs so that you understand what elections are available and the overall filing requirements. And then we'll look at some examples of how I typically see this reported and go over it. And then also, what are the common questions I get with the PFICs, and we'll answer those as well. All right, so the 8621. So basically, there are three versions of the PFIC. And I guess to back up, PFIC stands for Passive Foreign Investment Company. So it's a foreign corporation whose income, where more than 75% of its income comes from passive sources, so think interest, dividends, capital gains, or more than 50% of its assets create passive income. So that's what triggers a PFIC. And usually the way you see the PFIC, and the way we'll see it in this case, is through a fund, usually. So like a foreign mutual fund or a foreign ETF. Those are foreign corporations, and by definition, they are passive, and that all they do is create passive income and have passive assets. So that's what triggers these PFIC requirements, and that's why, when you see these fund type investments that, just like U.S. investments, they may invest in hundreds of different funds, minority pieces of hundreds of different funds. Especially if it's a foreign fund, they don't know about the PFIC rules, and so they're investing. They're not thinking about the U.S. tax consequences, but it does trigger U.S. tax consequences. So that's what we'll talk about. And so when you have a PFIC, the default rule is this excess distribution regime. So that's a 1291 fund, and what that means is any distribution or disposition, or so sale of that. So a distribution from that fund or a sale of the fund is going to trigger this excess distribution regime. There's technically, if any of you do, trust returns, it's similar to the accumulation distribution rules on a non-grantor trust. But there is a formula for what's considered an excess distribution. You look over a 3-year period, if the average is more than 70, if the distribution is more than 75% of the average of those 3 years distributions, and it's excess. So an excess distribution, so a distribution that meets that formula, and any sale is considered an excess distribution. You're taxed at the highest rate, and there's an interest rate. You have to look at the whole holding period of the fund, and there's an interest rate associated with it. So it's not a very friendly scenario. And this is the most common thing that you'll see. The other two are elections you can make to get out of this excess distribution regime. So you have the mark-to-market election and the QEF, the qualified qualified electing fund, not election fund, but same difference. So the mark-to-market election, you have to have a marketable stock. So the fund itself has to be traded on a public exchange so that you can actually track what the value is year to year. And then it is what it sounds like. You market to market each year, and you pick up the unrealized gain as ordinary income at the U.S. shareholder level. There's some rules around losses. But the point for us today is that the income, the way you report the income is different. But a partnership can file the 8621 on behalf of the partner for a mark to market. So they can make the election to treat the fund as a mark to market fund, and they can report the income so that the partner doesn't have to do anything from a PFIC perspective. That's different than the 1291 fund, where there is nothing that the partnership can do on behalf of the partner. If the partner owns a default 1291 fund through an S corp or partnership, then they have to file the 8621, no matter what. So the mark to market can be done by the partnership. The qualified electing fund, you can think of it like a disregarded entity. You can elect to treat it as a flow through. And this has a very narrow or a more narrow set of circumstances where it can apply. You have to actually be able to get financial statements from this company, but that's not the partner's problem generally. It's the partnership that's going to make this election in most cases. I say it's not the partner's problem. I guess that's not really true, but the partnership has to tell the partner whether it's a type of fund that can elect the qualified electing fund treatment, and whether the partnership has done that, because it's another one where the partnership can do it on their behalf. With both the mark to market and the qualified electing fund, if you don't make those elections in the first year, it triggers, you basically have to treat it as a deemed sale of the fund, and you're back in 1291 fund territory for that deemed sale piece. So you have to be a little careful just making these elections if you're not sure about the holding period and what the consequences are. But so those are the three types of funds that we're going to talk about, and that can show up through the K3, or the three variations of a PFIC. Two of them you elect into, and this one's the default. All right, so here's the common questions I get from the 8621. So, a lot of times on this first one, you get a K3 every year that has 10 to 100 PFICs on it, but it's not the same ones every year. So what do you do with the 10 PFICs that were on the K3 last year that you filed an 8621 for, and then the next year you don't see it on the K3? Do you continue to file the old one or not? So we'll talk about that. What if just basic information is provided in Part 7, which is the PFIC part, but no other information? So you just have a name, and sometimes that's it. What do you do with that? And then what's the risk of just ignoring it? What if you don't file the 8621? What are the penalties? What does that mean? All right, so we're going to jump into the examples here, and things to look out for. Part 7. If you see Part 7 checked in that first page, that means there's information in that PFIC section. It's Part 6 for an S corp. The S corp K3 is actually structured a little different, and then footnotes. All right, so let's go into the example. So if what I was just talking about sounded somewhat familiar to you, then this is probably what you've seen before. This is Part 7 on the 8621. We have all these different random funds. They give us the name, reference ID number, address, some dates, and they fill out one line of this, and then some couple random lines also filled out here. So the question is, what do you do with this? And I thought this is a good example to really go back to the questions, though, and just go through each one. So back to the question of, what if last year there were 10 funds that aren't included this year in here? What do you do with last year's funds? And I guess the best place to start actually is what's the risk of not doing this form at all? The 8621, there's a common theme with international information returns that there's a $10,000 penalty. So if you don't file a 5471, and this, obviously this is if, it's, non-criminal situation, but, it's a $10,000 penalty for the 5471, $10,000 for the FBAR, 8938, 8865. They all have the same $10,000 penalty for the most part. The 8621 actually has no penalty associated with it. So if you don't file this, there's no penalty specifically for this form. There is a penalty for, because this is in a lot of cases associated with the 8938, which is filing foreign financial assets with your tax return. So, I mean, if you own a PFIC directly, and you don't file the 8621, then you probably missed the reporting on the 8938. Now you have a $10,000 penalty for the 8938, but there's no penalty for the 8621. What there is, though, is a tolling of the statute of limitations for this form. So although there's no penalty, if you don't complete the required PFIC forms for a particular year, the statute of limitations technically stays open for that entire return for the whole year. So the IRS can come back to that year, and not just for purposes of the PFIC reporting, but for the whole return for an audit. So it never runs. So that's the reason why it matters at the end of the day. And so when you have information on a prior year that's not rolled forward to this year, to me, what that means is that there's no indication it was sold. So I mean, if you have a PFIC in 1 year that's included here, the only way it could be that they don't own it anymore is if it's sold, in which case it would be included here again, and they would show the sale. So I don't know why that happens in a lot of cases where they don't continue to report it on here. I think they should technically, but in my opinion, if you already have the old one in the software, just roll it forward so that it's in there, and you're just going to have a rolling tally. And then maybe someday in the future that you see that fund in here again and it's sold, and you have it in there, and you'll be able to report it as sold. And that's the other point. If you don't file the 8621s and there is gain or income that comes from that fund, then there's no way you're going to get the tax reporting done correctly if you don't do the 8621. Because you couldn't or it'd be hard to do the excess distribution math without filing the form. But anyway, so that's what I would say with if you have prior ones, just roll them forward and keep filing them. I mean, it makes the return ridiculously long, but it's really not a lot of work to keep it in there. If all they give you is the name and address information, then that's all you can report. To me, you put that on the 8621, that it's telling you it is a 1291 fund. It needs to be reported. It may be that the ownership is so small that there's not even a registered value of it. I don't know, but if it's on here, my suggestion is to file it, because technically they're telling you that there's a 1291 fund that your partner is an indirect owner in. So then you just fill out the information that you have at the end of the day. And the last thing I wanted to mention with this one is, part 1 or section 1 is really just general information about the ownership in the PFIC. Section 2 is more income information. So it tells you, here, this is the QEF information. Remember, the QEF is the disregarded entity type. So it's going to have so it would have the income. It would show the income, and then here's the 1291 information. If a fund was sold or there's a distribution, that's where you'd get the income information on the default rule, and here's the mark-to-market information. But remember, I said for QEF and mark-to-market, the partnership can actually make those elections on the partner's behalf, and that income shows up on the K1. And the instructions to the K3 actually say if the partnership makes either of these elections on their behalf, you don't put that on the K3. So this could mean two things. It could mean they did this wrong, and the partnership has filed a K3, and the partner needs to pick this up on the return. But I think it's more reasonable to assume, I guess, that they did it correctly, in which case what this means is that the partnership did not make this QEF election on behalf of the partner. And so they're giving them the information if the partner wants to make the QEF election. So unless the partner makes the QEF election, this is irrelevant. You can just keep filing it as a 1291 fund and not pick up this income. But I guess to say it more clearly, my take on this is that this means that this information is not already in the K1, and you only would have to pick up this income if the partner has made or is planning on making a QEF election for that year. All right, so that's that example. I want to keep moving here because I got a few more to get to. So this other example, again, you know you got a PFIC when this part 7 is a yes. So we know we're going to have to deal with PFIC. And so this is another similar situation. Remind myself. Okay, yeah. So similar situation here where, you know, they provide us the basic information for the funds. We have a little more information than the last one. And here we have one that gives us QEF income, and the others, again, it could just mean that there is no income or it's so small that it doesn't register here. So just looking at this, we're in the same situation as we were in the other example. But there's also a footnote associated with this one where they tell us that our KX fund is a foreign partnership. So just like we talked about with that 8865 example, where the investment, the K1 you're getting is actually a foreign partnership itself, that's the same situation here. So what this is telling us is that a foreign partnership cannot make a QEF election on behalf of a U.S. partner. So it's giving you the information to say, hey, these are eligible PFICs that you can make the QEF election on your own for. And so in this scenario, that's what I did for this client, is I made the election at the partner level because they're the first U.S. taxpayer in that case, is the partner. So I made the QEF election for the partner. And in this case, you know, there was no QEF income to pick up. And here I had to pick up income of 1405. So each year, now going forward, I'm going to get these same funds on the K3, and they're going to tell me the information. I've already made the QEF election. It stays in place going forward, and so I don't have to keep electing it. And I'm just going to pick up the information each year, file the 8621. So this is not included in the K1. So again, I think that's a critical point, is when you see the income in these sections, that does not mean the income is already in the K1. It means you need to pick this income up if you have made an election for either of these types. The other thing I'll want to point out on this one is this 1411-10G section. I hear this talked about frequently, and I feel like it's very misunderstood. But basically, what this means is, I mean, the 1411 is your net investment income tax section, and the -10G election allows you to create parity on the income from a PFIC and how it's taxed for net investment income tax purposes. So if you think about like a QEF election, it's going to be a disregarded entity. So we'd pick up the income in one year, but there may not have been a distribution. So 1411 doesn't subject it to net investment income tax until there's a distribution. And so what this -10G election does is it says you're electing to treat it as net investment income in the year it's picked up. So if you make a QEF election, you would pick that up as QEF income in that year. It's a tricky provision because it requires, I mean, you ultimately have to do it manually in the software because it doesn't flow that way onto the 8960. But if you don't make this election, it's very hard to remember to do it later. For example, you know, if you get a distribution from a QEF fund that's not taxable because a distribution, you've already picked up the income, just like how the rules work for a partnership. I'm not even sure that would show up on the K3, the distribution from the QEF. So you probably never know. And then you'd never pick up the net investment income tax, which, I mean, to be honest, is probably what happens 95% of the time with people. But just so you know what this means, because it gets thrown out around a lot. All right, last example in 8621, quickly. I'll put this in here just because I kind of think it's funny, because the whole point of the K3, you know, is to provide consistency. And the PFIC, I feel like, was their main objective, because that was where people got the most problems. So the PFIC, they said, the PFIC they went through a lot of effort, obviously, to create this section of the PFIC, and all they did here was just this client just said C statement, and then they just continued to do it as they did. As they've been doing it forever. So this is like what the old footnotes look like, and I still see this a lot. And ultimately, it gives you the same information. This gives you the basic information of the fund, and you need to report it on the 8621. Here they're saying it's a 1291 fund, no elections made. So really pretty simple in that case.